So you've probably just come from the previous presentation where we were talking about what financial accounting is and why it's so important in today's marketplace. And you want to get a feel of accounting, so you're like, let's record some transactions, and you're gonna need a business for that. So you're like, I got a business plan, let's create a business, heck with it, let's start it. But how are you going to structure your business? Well, we've got 3 different ways to structure a business on the left-hand side. These are very common ways to structure a business. A sole proprietorship is one, a partnership is another, and a corporation. So we're going to cover each of these, and I'm going to give you some basic outline as to what are the differences with respect to each of them. So let's start off with the sole proprietorship. As you can see, the name sole proprietorship kind of screams sole or single person. So you're going to have one single owner that kind of looks after the business, and the liability for them is going to be unlimited. So they're going to be liable, their personal assets are going to be up for grabs, and the business assets are going to be up for grabs as well if they go bankrupt and they owe debts. So just because you declare bankruptcy doesn't mean that your personal assets are safe. It actually, this unlimited liability means that your personal assets are not safe. So that is unlimited liability, and it only seems fair that you'll receive unlimited profit if you do generate profits from your business. Now the tax issue with a sole proprietorship is that it has to do, or it's based on your personal tax bracket. Personal tax bracket, and this can be favorable or unfavorable depending on how much income you make. So if you make just a small amount of income, then it might be favorable. If you make a lot of income, then you'll be in a higher income tax bracket and you'll have to pay more tax. So that could be an unfavorable part of a sole proprietorship. They're part of the personal tax bracket. And of course, the sole proprietorship, it is simple to set up. You have control of it entirely, full control. And of course, you have that access to either unlimited liability and profit. Of course, I don't think you want the liability, you just want the profit part, but you're going to have to take both of those as they come together. So the next one we'll be talking about is partnership. And a partnership is one that is with 2 or more people are going to form a partnership. And it can be 1, 2, 3, 4. I'm not exactly sure if there is a limit, but I don't believe there is. The liability is unlimited for just a normal partnership, in that it's the same as a sole proprietorship. You can, of course, again, your personal assets can be seized if you run into debts, as well as your business assets. And your profit, of course, is going to be split depending on the share of how much you have invested in the partnership. And the tax bracket for a partnership is going to be, again, the personal. It's going to be based on your personal tax bracket. So the income that is generated by your partnership is going to be paid out to the owners the owners or the partners in your company, and the income is going to go to you. And depending on how much income you generate, again, it can be either favorable or unfavorable. And of course, with more owners, you have more sometimes you have more creativity, you have a greater capability for innovation. You also have more capital, that is for sure, because with more owners, more people are investing in the partnership, and it's possible that it can grow quicker. And there's one thing I wanted to mention, and that is a partnership can be formed as a limited liability partnership. Usually you'll see this with accounting and law firms. What this basically means is that some or all of the partners have limited liability. So this means you are not responsible. So let's say this guy, let's give them names, Dave and Mike. So let's say Dave is negligent, Mike is not responsible for, or his personal assets are not going to be taken in case someone sues the partnership. So only Dave is going to be liable personally, as well as his business assets. So Mike is only liable up to the amount that he has invested in the partnership. So he's only liable for his business component of assets, not his personal assets. So just the business, just his business assets. And that's if someone sues the partnership for negligence or misconduct. And in some countries or states, you might actually need a general partner. And what a general partner means is one partner is going to have unlimited liability, because in some ways you can structure a partnership so that it's a limited partnership, so that everyone just has limited liability and none of their personal assets can be taken. So I just wanted to go over that. It was pretty quick, I know, to cover something like an LLP, but I just wanted to give you a preview as to what parts are kind of included with an LLP. So let's talk about the corporation. Corporation can have many types of investors. You can have 1, 2, 3, 4, up to tens of investors, or hundreds, or thousands. So the share base can really be split up, because you can have millions of shares. Of course, there's some companies out there like Bell or Rogers or TELUS or AT&T that have millions of shares, and the liability on this is going to be limited in that whatever you invest is only going to be you're only going to be liable for that amount. So if you invest, I don't know, $40,000 in worth of cash into shares of AT&T, then if the company goes bankrupt, you're only going to lose that $40,000. So you're not responsible personally for any of the debts of the corporation. And of course, the profit is all determined by your share in the company. So if you have a large share, you're going to create a greater profit, and the profits are realized through share appreciation, so the price of shares going up, or from dividends. And the tax bracket, it's a bit different. You have a corporate tax bracket, which is normally below the personal tax bracket. I think it's like 18 to 20%, I believe, depending on what country you're in. All states and countries have different corporate tax brackets, and that basically decides for some, or it kind of is, you have a choice as to where you want to incorporate your business, maybe because of certain tax rates or certain favorable tax rates. And with regards to other notes about corporations, well, of course, you have that limited liability, which is always good, but of course the corporation is more complex. It requires a lot more administrative fees for setting up the corporation and registering it, and so on. So hopefully you have an idea now as to the differences between a sole proprietorship, a partnership, also kind of understanding what a limited liability partnership is, and a corporation. So make sure to subscribe, and I will see you guys in the next tutorial. If you have any questions regarding accounting or any other material within our videos, you can tweet us at NotePirate. You can like us on Facebook to receive updates or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.